Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
It's Money on Tap's insightful Summer Sector Series, diving into the hottest investing sectors for the season. Each week exploring a different high-growth industry, analyzing major players, market trends, and emerging opportunities, with expert guidance to make smart investments all summer long. This week, essentials versus enjoyables, understanding consumer staples and consumer discretionary stocks. Your summer school session starts now.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name is Seth Cressman here with Ben Brayshaw and Dan Mickelin. How are you guys doing today?
I'm doing good, Seth. How you doing, Dan?
I'm doing really well. How about you?
There's so much energy inside the series that we're doing, the Summer Sector Series. I think there's a lot of, we have been digging through stuff like, we're talking, Dan, some of the stuff, actual factual data stuff that we don't use in our everyday quantifying of how to invest. I'm kind of like, I feel like I went back to school a little bit on some of this stuff. I'm like, oh yeah, that is a point, or that is a thing. And whether it comes out on the show or not, it's just fine tuning some of this early learning is kind of funny on specifics, and it's been a good refresher for me too. This has impacted me a little bit. I can't lie. I'm enjoying that, but it's been a learning experience. How about you, Seth?
Yeah, I'm right there with you. I love how you use the back to school, because that's where we're at. We're doing this Summer Sector Series. It's our back to school or summer series that we're rolling out, and it is a lot of fun because these are important foundational elements to investing, and they're a part of everyone's portfolio, whether you like it or not, or realize it or not. These are all things that really get baked in behind the scenes. And in a larger picture, we're kind of covering that macro, and then we're getting into some of the more technical pieces here that really is appealing, and it's fun. It's engaging. It's getting everybody to really think a little differently. And gosh, I cannot wait to do that. Now, I was going to say personally, something that was really fun for me to do, and I haven't even shared this with you guys. This is going to be cool. Yesterday, I hopped on a Zoom for Real Men Wear Pink. Are you familiar with Real Men Wear Pink? I know Ben is, but Dan, I guess this one's for you.
I am not familiar.
Are you sure, Dan? Are you sure? This has got to be good. Go ahead, Seth.
Yeah, a bit of a long-standing joke there between Ben and I. Well,
not sure where this is going, Seth. I'm getting a little nervous.
I know you should be. As you know, you should be. Anytime I'm probably have a microphone, you should be nervous. So we're going to be doing, we as in a good group of guys here are going to be doing fundraising for Breast Cancer Awareness Month. And we just kicked off this informational Zoom yesterday. There's going to be so many things that we're going to be doing to raise awareness and to raise money. And it's going to be a lot of fun. It's the Real Men Wear Pink campaign. So I can't wait to really share more about that with you. But that actually gets me thinking. We're going to have a 4th of July here right around the corner. Going to throw a bash here at our house. It's going to be the whole neighborhood's invited.
Everyone's
Flyers,
invited.
Band.
Seth,
everyone.
Seth's address is...
Don't take it personally, Ben, Dan, if you don't get the invite, but it's out there for everyone.
Yeah, that was rough.
That was a little painful.
It's going to be great. We're going to have live music. We're going to have one of those fun, bouncy water slide things for all the kids. There might be some fireworks. Some of them legal, some of them may not be. I don't know. We'll kind of see what shows up and what happens. But part of that is we're going to build in this awareness for Breast Cancer Awareness Month and an opportunity for people to become a part of that. You know what? This is not a golf tournament. You know what I mean? It's a party, people having fun, and it's just a new way for us to engage and really support something that our hearts are for. And we've had American Cancer Society on the Money on Tap before, so it's it's really just a part of who we are at Brayshaw Financial Group and Money on Tap as well. So I couldn't be more excited.
I like that, Seth. That's great awareness. I appreciate that very much. I know for a lot of people that's a very personal scenario, and a lot of people suffer with that. And I'm glad you guys are engaging that way. Disappointed I wasn't invited, but maybe Dan and I will host our own party without you. So
It sounds like you might need a Fire Safety Awareness Month come August.
Yeah.
Make sure everything's going well over there, Seth.
With that, guys, we have a great show, and this is the Money on Tap Essentials versus Enjoyables. Now, we're going to be digging into understanding consumer staples and discretionary stocks. If those are unfamiliar terms, don't worry. We're going to go ahead and get into some of the introductions on those for you and familiarize you with them, as well as we're going to start rolling out some of the nitty-gritty stuff, some of the details of how these are used in portfolios, so the application of them, why they're important. And ultimately, we have to always, kind of put this out in front of a show that these are not recommendations. We're not telling you to go out and buy these. These are just really a great way for you guys to just have fun learning about some important things for your building your portfolio.
Yeah, I would say that these are, two very, they're very diverse conversations. A lot of people don't understand the concept between consumer staples and consumer discretionary, and really breaking down the difference. And we've called it essential versus enjoyable, and that's really a good way to test that theory. I think of it as like toilet paper versus buying Tesla. There's really the core needs, and then there's the core not needs decisions that you make as a kind of living your life. And they're all things that we as consumers buy, and I think that's the whole point of it, is really just understanding the consumer as a whole, and where are you spending your money. Where are you spending your money? Probably everyone else is probably spending their money. And I think, when you start looking at where you're spending your money, those are the companies, I always say, that's really where you want to be focused, because those are the companies bringing in the revenue.
Yeah, I think a good way to look at this is, we've had this conversation lately with a handful of clients. It's, it's around, budgeting. It's needs versus wants, right? You can list these companies and these investment opportunities probably right down the ledger of your monthly budget sheet by saying, okay, these are the things I need to have. That's going to be your staples. And these are the things that I want and spend that extra money on. And that's going to be more likely to be your discretionary type stocks. So there's a couple different ways to kind of frame the perspective on this. And I think we've thrown out a couple good ideas there. But there are certainly different conditions and times in the market world. So stepping outside of your household budget and taking that kind of higher view perspective, there's different times and different conditions where you would potentially want to be invested more so in one versus the other, and we'll dive into that as well.
Well, speaking of focus, it's time for Money in the News.
Apple won't roll out AI tech in EU market over regulatory concerns. This article coming to us from Yahoo Finance, Sam Stolten and Mark Gurman. Thank you for that. And what this article is talking about is that there is this particular legislation, that's been drawn up by the EU called the Digital Markets Act, that's been designed to protect both the consumer and the spirit of competition in the European market. And the spirit of competition thing has long been a challenge for Apple. We have had issues here domestically on some of these fronts as well, and it really boils down to Apple doesn't necessarily want to play fair with the competition, or play nice is probably the better word. And in face of this legislation, what Apple's stated that they're going to do is they're going to not roll out their AI feature, as well as a couple other updates that they had planned, which were met with rave reviews here earlier in June at a tech forum here in the United States, and led to a quick spike in Apple stock from the investment perspective here. But their point of view on this is that, if the European Union wants to play hardball on this, then, they're willing to set aside these updates and not roll out these new features that are going to be available in their latest models and let the consumers, let the politicians know what they think about that. So they're banking on an uproar from the consumer to kind of override some of this legislation that's been drawn up there.
They're also playing up how good everything is, too, to irritate the consumer of what you don't have.
Right.
I mean, how hard is it to convince people on a material level, like materialism, like you don't have this and you should let your government know. Yeah. I mean, they really are blackmailing indirectly, all the blocks. And that's an issue across the board. I am concerned about the overall control. I mean, honestly, if Google and Apple ever, wanted to take over the world in a combined effort, they could by just shutting down cell phones. I mean, literally, all of us are dependent on those things, and it's really almost too much power across the board. I'm generally concerned about the level of weight these companies carry as a whole, and a lot of consumers are. I mean, we invest in them, we manage through them, we look for their profits and their yields. I mean, Apple has just a ridiculous amount of cash on hand, and they're, whether it's a car or a phone or a TV or a computer, like they are in everyone's pocket in some way. I would honestly tell you that it's just really scary. I think this kind of action, I mean, I really appreciate the EU taking a stance on this stuff. I don't know about you guys. I wish the U.S. would do more of this. Apple has, and I don't blame Apple from a business standpoint, leveraging their own resources as a primary piece, right? Like, would we as a business say, hey, you can do business with us, but this guy over here is just as good. Like, we're not, advertise that. I mean, that's not good business, but they are on a multi-set platform. So it's complicated when you look at it from a business perspective. And I think that kind of socialistic perspective comes into play, like, well, everyone should be able to play fair in the same. And that's not necessarily the right thing either. So I have mixed opinions across the board. I think a lot of people do.
Yeah. When, you get to a technology that's kind of, and that's what people talk about, that's so great about Apple. And frankly, I'm one of those people that held out on Apple for a long time just because I was like, I don't like those kind of, I don't like that. I just don't like the whole Apple dominates everything. It's everywhere. It's everything, but eventually I kind of broke down myself to wanting to do some of the simple technology interfaces that Apple does with other.
You're talking about actually owning Apple, an actual device. You're not talking about the stock. I mean, just to clarify.
Yeah. Clarify. Yes. Thank you. Yeah. So, those are, I'm looking at what are the things that they're going to be blocking here. It's, Apple Intelligence. Okay. iPhone mirroring, SharePlay screen sharing from users. So those are some of those things where I'm like, well, that's one of the reasons why I own Apple or a Apple phone, right? Because my whole family has it. And then if you are in my family, which there's a couple of those we won't name here. Okay. Almost did. Not going to. They don't get to enjoy some of the features that Apple and benefits that Apple has inside of the universe of Apple. So I don't know. It's much larger. It's a different story, and I appreciate again what they're trying to do, level the playing field a little bit. At the same time, why not?
One thing I didn't like about this legislation, the way it's been drawn up, is that they identify 6 companies that they consider to be gatekeepers, and that's the terminology they chose. I'm not quite getting it, but they're looking to these companies to, kind of be the bellwether, the test that they're using to determine whether this Digital Markets Act is being followed tightly. But the companies that they list are essentially all American companies, and it's the ones you would think. It's Apple, it's Microsoft, it's Google. So they are the leaders in this space for a reason. They invest the most in these technologies. They reap the most reward from them, of course. But the notion that, in order to do business in Europe, they're asking these American conglomerates that have spent billions in research and development and found a way to dominate these markets over decades, that they need to somehow level the playing field or make it easier for local competitors to do business in a space that they own through hard work and technology and innovation. that just rubs me the wrong way a little bit. Like I think you had the right word there, Ben. It is kind of a European socialist approach to this, whereas more of a kind of free markets capitalist. And I would expect that the best product should win and shouldn't have to kowtow or make it easier for a competitor to do business in a space that they've invested in. But a bit of a socialist approach.
Yeah.
Hey, speaking of rubbing you the wrong way, Dan, prosecutors urge Justice Department to file criminal charges against Boeing over the 737 MAX. This is a Chris Isidore and Evan Perez CNN article here. You guys, it is a funny, but not. It's a funny introduction into a not funny topic for sure, because we're talking about one of the bellwethers of the Dow of our investing in U.S. companies. That is just it's sad to see where the state of Boeing is, and that mismanagement of their newest fleet in the 737 MAX has had so many problems, and that the ultimately here the what happened was that the financials that they were being hit with in response to the 737 crashes and those deaths that occurred as a part of that were just about to get past their due date, and instead they had the Alaska Air, if you remember the Alaska Air door that came off the Alaska Airlines plane happen. That incident happened. So now this is coming back and circling back around to being potentially a really big problem in criminal charges against Boeing.
Yeah, this is a nasty story, and this is a bad problem for Boeing. I've had a lot of people call me about Boeing. I've talked to probably 24 people about Boeing Holdings and so forth. You obviously can't make a recommendation on air online. I usually tell people that, when your downside looks potentially worse than your, potential upside, there's enough unknowns that when you have a known, like maybe, as a, Jerry, kind of Joe boy, investor, you're fooling around, like don't play with companies like this. Like it's not worth being, if you don't own it and you're not, you can't quantitatively understand what you're buying, when you're buying, how you're buying it, like buyer beware. I mean, these people have doors flying off. They got planes crashing. I mean, I don't want to be around something like that.
Yeah, whistleblowers being snubbed.
Yeah, and then on top of it, so you have all these families. What's going on is I have all these families writing letters to Congress and saying, hey, you got to do this, X, Y, Z. And they're trying to get Boeing hit with the maximum fine, which is like almost $25 billion. Boeing only has $7 billion on hand in cash. This would put a huge crunch on Boeing, on top of the fact that they have been losing money hand over fist. Its operating losses have posted nearly $32 billion since the grounding of the 737 and the fatal crashes. So, this company's hemorrhaging. That's how I look at this. And,
you're talking about what are the consequences here? You're talking about a downgrade in their debt, right? From A to junk bond holdings. You're talking about them not being able to engage with the government contracts because they're criminal.
Yeah. The thing that bothers me the most, and you mentioned the whistleblowers, being murdered.
I should be careful saying that. That was just something little
well, they're dead.
Clickbait that I caught.
They're dead.
Yeah.
Okay, so it's not like they're dead. Two of them,
they are.
Ironically.
That's the truth.
Yeah, so
circumstance is hard to say.
That being said, none of the executives are being looked at to be personally liable. One accidental death from some random thing, okay, but this is starting to smell like the Clintons. Come on. So it's like I don't know what the statistics of the number of suicides for people who are used to work for the Clintons are, but it's the highest in the world and beyond accident at this point. I just look at all of these things and say to myself, because the conversations people are having with me, Boeing's been hit, and they've been hit hard, and they've been hit hard again. Is it a great time to get into Boeing? just stay away from big questionable companies. It's hard enough to make money in the stock market that you have to be guessing and gambling on things that have all sorts of speculation going around. And that's my thing is, if you don't own it, you don't know what you're doing, stay away. Hey, great. If it goes up, you missed out. Be beware. No advice here. I'm not pandering anybody to do anything on the stock. But that being said, this is a real problem because they're one of really two airplane manufacturers, and if they do drop from investment grade, that's a big problem in our country.
Yeah, I mean, I'm generally a buy the dip kind of investor. I look for opportunities like that, but there's just so much bad news swirling around this that I don't.
Every day, away. It's like a new.
Yeah. And it's not just that they're struggling to manufacture a good product. There's this. Just the legal implications here are just astronomical.
Yeah,
but they are an essential company. I mean, they're huge in the defense sector.
If they're lying, do you want to get on another Boeing?
No, there's a lot of stuff. A lot of bad news here. Basically, all bad news.
Yeah.
So.
Well, this is good news. Money on Tap is a wrap. We are going to get into the essentials versus enjoyables Money on Tap show here. We're going to understand consumer staples and understand discretionary stocks. That's our goal for you here at Money on Tap as we are in our summer sector series. Yeah, don't go anywhere. We'll be right back. Hey guys, Seth Cressman with Brayshaw Financial Group. Are you ready to take control of your financial future? Look no further than Brayshaw Financial Group. Our team of experienced advisors is dedicated to helping beginners like you build wealth through smart investing strategies. Visit BrayshawFinancial.com today and start your journey towards financial independence. Brayshaw Financial Group, your partner in wealth creation.
Thank you for joining us for Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's show with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You know what I forgot to mention? And I love giving you this opportunity while we just take breaks. And that is to go subscribe to Money on Tap. We're a podcast. You can find us in any of the venues out there. And not only is it great when you do that you can find us and listen to us anytime you want, you can grab an episode and share it with friends, share it with family. And we know that that's a gift, right? When we're generous like that, that's just one of those things that just continues to give back. It's one of the ways you can give to us, and we appreciate you for it. And because of that, we want to recognize you and we want to thank you. Send us an email at info@yourmoneyontap.com. And when you do that, make sure you include somewhere where you can send you some Money on Tap gear. It's, believe it or not, the holidays are going to be here before you know it. And there's nothing better than opening up a gift and seeing Money on Tap during the holidays. I know my family enjoys all of the Money on Tap gear I give them, right? Why not include that as a family tradition too? Oh my gosh, we're gonna get into the essentials versus enjoyables. Now, this is a couple of sectors we're doing simultaneous, and why we're doing that is because they're almost interchangeable at times, and they're so easy, I think, for people to kind of get a little confused. Like, what's the difference? These are both things that, we're spending money at the register to buy certain items. What makes it an essential, or what makes it a staple? And how, besides that, how do these look inside of the event of investing? And I say an event can be really like over years and years and years and years, or a life cycles of investing. Are we looking at 5, 10, 20 years of investing? How do these things work differently? regardless, you're going to get an opportunity to grab hold of these, understand better, and hopefully have a healthy relationship inside of investing and we talk about that in Money on Tap. Be successful in your investing. That's our goal for you here. And with that, let's explore a little bit more in the world of consumer staples and discretionary.
Yeah, the one thing about the S&P 500, which is what we're talking about, right? We're talking about the 11 sectors in the S&P 500. So if you're not familiar with the S&P 500, those are the 505 largest U.S. companies. If you ever really want to sound smart at a party, just say, hey, it's 505 companies, 505 stocks, but there's 11 sectors, real estate being the 11th. And sometimes people exclude real estate from, talking about the S&P 500. They kind of pull that out sometimes. And of these 11 sectors, you have consumer staples and consumer discretionary. Probably two of the things that we all as consumers engage in the most. These are the stores and the companies and the providers that we literally consume across the board. And I think, the kind of the basic parent conversation of what is a staple versus a discretionary event. And we talked about, essentials versus enjoyables. Your staples, that's going to be your toothpaste, your toilet paper, the things that in the worst economic climate you could possibly imagine, you're still potentially buying these things and using them as, like you're still going to shave possibly. Like there's, but the discretionary starts really getting into the things that you get to decide to do with your kind of extra money. Now, I joked around about toilet paper versus Tesla. Like Tesla is considered a consumer discretionary because ultimately EV or, driving an EV vehicle is a discretionary, but some people might think that's a staple for their life. There's these kind of confusing conversations that exist. I think it's funny because when I think of, staples, I think of, Procter & Gamble. That's kind of the normal one that you kind of run out with. But what's really funny is that you start getting into things that, these staples, they're like Pepsi and Coke, Target, Walmart, Costco, there's just all General Mills, like kind of these very, very core brands, Campbell's Soup. These are like, storing, non-perishable foods and so forth. But when you get into that discretionary story, it's the idea of like, I want to upgrade my bathroom and I'm looking at Home Depot for a new tub or Lowe's, Amazon, Tesla. I thought it was funny because I totally get that like Nike and TJ Maxx and so forth, those are all consumer discretionary. But, McDonald's is consumer discretionary. For some people, that's a staple. I get it. Like, I totally understand. But when you start really breaking down all of these different moving parts, when you think of Amazon, like the confusing piece about Amazon is that are you buying staple items there or are you buying discretionary items? That creates a lot of this, back and forth conversation of like, how do you look at Amazon? Is that going to be a staple maybe in your portfolio from a perspective? But our world and industry considers it consumer discretionary. This is a complicated conversation. We talked about this with tech. There are these overlaps that make it very complicated to do that. And that's where, you start getting into really understanding the quantitative analysis and where companies are making their money. Truly in a World War III kind of environment, people are probably not paying for Amazon Prime, right? They're saving aluminum foil. There's like you're living off of pure staples and you're figuring out how to get them the cheapest you possibly can. Will Amazon play a role in that space? I have no idea. Will they totally get rid of Amazon Prime for a period of time in war just to help people get what they need? I don't know. All conversations to be had, but really breaks down the complications of trying to figure out how you build staples in your portfolio and what that means historically. One of the things, guys, I really am excited about disclosing today is how consumer discretionary and staples can, should, and could be used in someone's portfolio as they're trying to figure out how to diversify, invest, and build a portfolio, whether it's for an accumulation period of their life or a distribution period of their life, like retirement or estate planning.
Yeah, I think what I found interesting in getting prepared for this is, whenever I'm asked about the economy and you have kind of those really high-level conversations, the United States, our economy is a consumer-driven economy, right? Our economy is robust because Americans spend money. So in looking at, again, the whole 11 sector breakdown, Ben, and we talked about that, how these different sectors carry different weights at any given moment. I was kind of surprised to see that the two of them combined represent about 16% of the overall S&P 500 from a sector-weighted basis. And I expected it to be higher, honestly. I really thought it would be more than that. And the consumer discretionary makes up just about 10%, and consumer staples about 6%.
Which is really low. I mean, I think.
Yeah, I thought that was low too. And, thinking about your comment, Ben, about where they fit in the portfolio, and we were talking a little earlier in the open about the times and the conditions when one may be in favor versus the other. I think this is another conversation where interest rates come into play, right? And understanding that the difference between the two, it really comes down to essentials versus enjoyables. Your essentials you're going to buy even in a high rate environment. And there's another terminology for the sector that comes up a lot that could be confusing for people if you're listening to any of these MSNBC style investment shows. They talk about defensive versus cyclical. You'll hear that terminology a lot. And defensive is your staples. All right, these are the investments that are likely to meet a couple criteria in terms of where they fit in your portfolio. Number one, they probably pay a dividend. A lot of consumer staple stocks offer a dividend, which is important, and particularly in a poor market environment or a high interest rate environment. And because they are essentials, they're likely less volatile. So they're more of kind of a bedrock foundational type of a stock investment, along with utilities we spoke to last week. I mean, you need electricity, you need heat, all those things you have to have kind of regardless of what's going on in the world just in order to survive. Versus the cyclical side, which is the discretionary, which cyclical means in this sense, and I've heard different interpretations of that, whether that's a seasonal thing, fall versus spring versus summer. And no, the cyclical terminology really means, when the market's good versus when the market's struggling. And when the markets are going well and you're in more of a growth opportunity phase, that's where the discretionary stocks are likely to outperform. When the economy's good, market's roaring, people are looking for opportunities to invest in things that, have significant upside. So they're less likely to pay a dividend. They're more of your growth style of a company. So when you're kind of choosing amongst the field here, and we're going to get into some specific companies and potentially investments for you, how do you decide which way to lean, or what portion of a portfolio do you build off of with these things? My advice, my take on it would be the staples are obviously more conservative, more foundational, kind of tried and true through all conditions type of an opportunity, where the discretionary you probably want to choose wisely for when you're or at least allocating towards growth or looking to really capture some upside.
Just as I know you meant CNBC earlier. You said MS.
Did I say MSNBC? I'm sorry.
CNBC. MSLSD. Well, I think it's really interesting, Dan, your point about the 16% between the two and that they crisscross so dramatically. And then, there are staples in people's life like electric and so forth. But the truth is the core is the food. That's food and shelter are really, really important. I think it's interesting that consumer discretionary is the fourth largest sector, and consumer staples is actually the fifth smallest sector. And like that, there's like 18-20% of the world is kind of in between them with consumer discretionary and industrials, and so you'd almost think that they would be closer, like in percentage wise, just because. They overlap so much. As I kind of digging through the quantitative analysis of these two sectors, what really creates a lot of complication, and I think probably the most, knowing something about a sector and investing in a sector is totally different, right? And so, I'm looking at, the various comparisons of, consumer staples versus consumer discretionary, and if you were to look at all the ETFs and funds out there and so forth that focus in this space, the returns are so broad. They go from just a year to date scenario, the lowest performer is negative 1.56 this year, to the highest performer being 10.65. I'm just that is a huge range, and same with the staples. You have, this is even more dramatic. negative 7.21, and that's a small cap consumer staple fund, all the way up to this is like over 9%. I mean, a huge broad range. So, I mean, when we talk about investing, like sometimes like you think, well, I'll just buy some random generic ETF or fund or whatever and try to get myself into that space. But the truth is then there's a like kind of best of class or where you want to kind of target, because like we spoke about with technology, when you look at these ETFs, they may only own, 10 stocks in the top 30 or 50% of their entire holdings, hence there's a lot of companies out there to be buying. And, evidenced by the random variable of performance comparing, what is that, 10 on that list, Dan? I mean, yeah. There's a lot, but I mean, the variables all in between, it's like negative 1, 2, 12, 2, 7.8, 7.28, 5.34, 2.4, 3.07, 1.6. I mean, they're all over the place. Which one should you buy? And so I think that's really where it gets into really being a planner and understanding how this stuff works.
Great questions and a lot of food for thought there. We're going to take a quick break. When we do, please, I know you've already asked, hey, how can I help Ben and Dan out? And, maybe you've asked the same question about me. There's lots of ways, but the one I would offer is just subscribe to the podcast. It's Money on Tap. That helps us out. Share it with a friend. And just continue to be generous and be you. And we're going to get back here with more essentials versus enjoyables, understanding consumer staples and discretionary stocks in just a minute. Don't go anywhere. You're listening to Money on Tap. We'll be right back.
Hey everyone, Dan Mickelon here with Brayshaw Financial. Looking for a hassle-free way to invest? Look no further than Brayshaw Financial Group. With Brayshaw Financial Group, you can start investing with as little as $100, enjoy a user-friendly platform with a diverse range of investment options. Visit Brayshaw Financial Group and start your investment journey today. Brayshaw Financial Group, investing made easy.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are in our summer sector series, and we're talking about sectors of the S&P 500. And as we work our way through, two of the sectors that we're talking about today are consumer staples and discretionary. So those are two different sectors of the S&P 500 that bring a lot of conversation whenever you're kind of watching financial news or investment ideas. They bring a ton of conversation and topics to the table. And depending on what kind of a consumer you are or what kind of an investor you are, it is going to make a big difference in how you approach these sectors and how you would like to see these work through your investing strategies. So we're going to talk a little bit more about the kind of investor, what to look for, why these will be appropriate or inappropriate for you based off of what your goals are, where your time horizon is, and kind of who you are right now in the cycle of or lifespan of your investing.
We talked about the kind of the randomness of the returns of the various consumer staples and consumer discretionary ETFs, and what we did was we just kind of just printed off two of them, and I think it's healthy to kind of have a perspective. But we looked at the spider sectors, specifically the XLY and the XLP tickers for analysis, so you guys can kind of chart along with this. These are neither performers or underperformers. Well, they may be in comparison to the various yields, but I would say that in the consumer staples area, the year-to-date return is 8.96 according to the chart I'm looking at, where, that's not the top performer. But then you go look at the consumer discretionary, and then year to date, they've only done 1.69. So they're probably an underperformer. So this is kind of a, middle of the road conversation as much as we can think, and just compare the same company doing two different sectors. And I think, when we talk about consumer staples, we talked about yield and collecting a dividend. And, obviously the consumer staples side is significantly more focused on yield assets. That's where a lot of people look for their space in that. The current yield's about 2.7% on the consumer staples. And those are the Procter & Gamble's, Costco, Walmart, Coca-Cola, Pepsi, Philip Morris, Colgate, Altria, Target. I mean, these are the companies these are the top 10 holdings. I think I got them all. And, then you have the consumer discretionary where it's paying like 0.7%, Dan, I think, or something like that, almost 0.8. That's going to be your Amazon, Tesla's, Home Depot, McDonald's, Booking Holdings, TJ Maxx, Lowe's, Nike, Chipotle, Starbucks. Those are going to be your top 10 index weight, across the board there. This is really interesting for me because, when you start looking at these things, people kind of quantitatively say, well, what's this thing done since inception or for the last 10 years? And, for consumer staples, that kind of like, really value play, for the last 10 years, the total return on that, the net asset value is 8.39%. Oh, I make 8.39%. Not bad. But then you start looking at the consumer discretionary and you say, well, that's about 11.66%. Same net asset value comparison. And you're like, well, hey, I'd rather make 11 than 8 on average, right? But these investments, and I think we've chatted about this a lot, guys, in various circles of the conversation, really one is more of an accumulation asset and one is more of a distribution-friendly asset. And when it comes to consumer staples, the reason we talk about distribution and what's relevant there is because of this really nasty thing called compounded loss or sequence of returns risk. And the idea that when the market's down or pulls down and you're still taking money out of it, you're really amplifying that loss in a kind of a very magnified, amplified scenario that creates recovery to be very, very difficult. And so as we're kind of looking at these different pieces, we started going through like where is the max drawdown? What does that look like? And how does that play into this?
So one of the things Ben is talking about right now, if you're unfamiliar with some of the terminology, right? And that's one of the things we just all suffer from is itis, I guess, as financial planners. We just kind of go into the vocab, right? And Ben's talking about max drawdown. Dan, get us up to date. What are we talking about and why is max drawdown and why is this important in Ben and what Ben's saying?
Well, it's just a measure of historically how far that stock or that ETF has fallen, right? So what's the biggest loss potential that history tells us that you're exposed to if you get invested in something like that? And I think Ben could pick it up back from here, but yeah, max drawdown kind of is the downside capability of the investment you just made, and you need to be aware of that because in simplest terms possible, that's how much you could lose.
Yeah, so this max drawdown, this maximum loss history event. So I have a 20-year consumer discretionary, like buying those Lowe's, Home Depot kind of worlds. Well, it's great that you had this 11% annualized return for the last 10 years, but in the last 20 years, the most you could lose at any one point in time is negative 55%. That's more than half your money. That means you just lost half your money. You put $100,000 in, you have half of that or less than half of that. But this is the real problem. Just the recovery, not taking any money out, just saying, hey, I'm going to let the money sit there. I want to see it recover. It took 45 months to recover the money. I mean, that's almost 4 years. So you would buy the index, you lose 55% of your money, and then you have to sit 4 years without touching it just to get back to square one. I think that's the really complicated scenario because that kind of history can be extremely painful. Now, looking at consumer staples, you're like, well, Ben, how bad is that? And I mean, this is better, but it's not. I mean, it's not lightning years better, but in the last 20 years, the worst loss you could have experienced would be negative 28%. Virtually half of the half you would have lost from the previous one, but it took 28 months to be recovered. Now, this compounded annual return for the last 20 years on this portfolio is actually almost 9%, theoretically. Oh, not theoretically, but that's the historical on it for 20 years. We were talking about 10-year returns. And Seth, as I'm digging through this, we talk about this all the time, and it's so hard for people to really internalize this in their portfolio. And that's understanding that it's not how much you make, it's how much you don't lose.
Well, in comparing those two numbers, I mean, you're comparing the two index options there. Are you willing to take twice the risk to make 25% more gain? Is really how those numbers break down.
No, that's a great point. And I think that's our point is that if you can sit and ride it, you're like, hey, listen, this market's good enough for me, and I'm happy to hang out and partake in this thing. And eventually I'll probably be in those averages of the discretionary purchases. I'll look for a good entry point. I'll look for maybe a sell-off period to just start getting in because I really want that 11%. If you think that that's what that's going to produce historically moving forward, well, then great. But if you have to do a distribution portfolio, the discretionary portfolio could be your enemy, and that's a real problem. And I think what makes the consumer staple portfolio, and you can look for other consumer staple ETFs that have higher yields and all sorts of different things, but at least with a consumer staples portfolio, maybe the dividend yield might be enough for you where you don't reinvest it and you just take the income off and you let it go up and down and ride it. I mean, that may just be the play that you're looking to do.
Yeah, I think in taking a look at, a couple periods in time where the market has gone through a lot of turbulence and some really difficult periods, it's good to take a look at how these two sectors have performed. And if you look back to 2008, which was one of the worst market conditions we've experienced in quite some time, consumer staples, took a good hit. It dropped 15% in that year, but nothing compared to what happened in the discretionary side. That loss was almost 33%, 32.97%. So again, talking back to that example about max drawdown, it was about 50%, right? Yeah. It was about half of the loss experienced. And then you fast forward to 22 and kind of the whole COVID experience, consumer staples barely lost anything, 0.83%, versus discretionary suffering by 36.27%, which is another massive loss. And I think that made sense, right, when we went through the staples period or the
toilet
COVID,
paper. No one could get toilet paper.
Toilet paper. That was probably driving that whole gap. I mean, that was the big difference between those two experiences is, the mad rush to hoard toilet paper and all those other things that were just essentials. So, I mean, it's just coming to me now, but I mean, talk about highlighting the importance of the essentials index, right? There's the whole COVID experience. When stores were shut, nobody was delivering, you quickly discovered, hey, what do I really need?
Yeah, I think that's a real educational piece. But again, it's about what you don't lose. It's not necessarily how much you make. And so I think when you look at, and you can, and if you want to contact us and you want to see like a drawdown, like take income kind of scenario from, either one of these portfolios is just, or either one of these allocations or any version of allocation, we can do that, right? I mean, we can set up literally send you a PDF of, hey, listen, so reach out to us. We'd be happy to show you the difference of a drawdown of 5% against either one of these allocations and see what that does for you long term. Because I think that's where you really see the difference. It's sad that XLY doesn't, or the discretionary, as we talk about it, or the XLP, the consumer staples, the returns are significantly different, but one's really a buy and hold and the other is more focused on providing yield long-term and trying to preserve that asset, the better side.
Yeah, where rubber meets the road, that's it. When you're going into your retirement and distributing the assets, how do you do it? Which allocation is really going to support your goals in retirement? Ultimately, how do you have greater income, longer portfolio life, or sustainable portfolio, healthy portfolio? It's really how you put it in, how you use it, and getting familiar with some of those concepts here at Money on Tap. And that's where we're at. We're going to take a quick break. When we come back, we'll be talking more about essentials versus enjoyables, understanding consumer staples in the discretionary stocks here on Money on Tap. Don't go anywhere. We'll be right back.
Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Group and our planners are here to help. Our team of experts will provide personalized advice tailored to your financial goals. Visit BrayshawFinancial.com today to schedule your free consultation. Brayshaw Financial, investing made easy.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Talking about essentials or enjoyables, really understanding a couple of essential and enjoyable sectors of the S&P 500 and how those work in your portfolio. So with that, limited amount of time left. We want to make sure that we get the information to you. Let's go.
You know, I think we're not recommending that you just go and buy one of these sectors. I think that's, one of the things I want to make sure that does come across from the show. We're not saying go buy, we look for entry points in these sectors. We actually do invest in sectors directly at times, and we have various strategies around that. What our real goal here is for you to walk away from understanding what you're buying. This is a learning experience for you to really quantify and qualify how to, choose your investments as best you possibly can inside a constantly changing market. With all-time highs, there's some articles out there that would show all sorts of concerns in the market. There's indicators that say the market's going to fly. You'll find every varying decision. But that's not what drives investments. What drives investments is what you're trying to accomplish. And, when you actually start looking at these two different plays, like if you're in an accumulation phase, maybe discretionary is an allocation for you. If you're in a distribution phase, maybe staples is really the allocation for you. But maybe neither of these is the allocation for you. Maybe you're super conservative and you're saying to yourself, I only need a short rate of return. I need 3-4% of my assets. Well, maybe a bank rate, a money market or something is appropriate for you. You really have to quantify the risk here. And I think that's what we're really trying to get at in disclosing all of this data, which a lot of people don't like, but understanding how far these things can fall on you historically is really, really helpful in you trying to understand the risk. And I think that's our real goal here, is to educate you on that and educate you on the risk of these.
Yeah, this process, the Summer Sector Series, has been eye-opening for me, and I've taken a look at a lot of different names that I hadn't looked at in a long time, and I've appreciated that part of getting prepared for these shows. Just to kind of discern between last week and this week, last week utilities are kind of a classic defensive play, kind of a stable, foundational element of a portfolio. Well, I left that conversation thinking, hey, you know what? There's some real growth opportunity in this. Things are changing. This just got exciting all of a sudden for the first time in forever. But in contrast, looking at the materials getting ready for this show, consumer staples, still defensive, not a growth play, nothing exciting there. I'm learning things as we're presenting the information, and I'm excited about that. And this has been an eye opener. Like I said, I'm looking at tickers that I haven't looked at in a long time.
Oh, I know. I'm like, wow, I hadn't even thought about that. I'll check that one out. What's going on? We scan stocks all the time, but we're scanning them. We're scanning for specific things. We're not actually saying, what's this stock doing, unless it's brought to our attention. And I think that's kind of funny. And I found that to be also interesting. We kind of work in silos at times, and then we kind of come together in these. And the radio show is great because we talk about, wow, that's what you've been doing all week.
I'm taking notes every week.
So, anyways.
You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. As always, be successful in your investing. Make it a great week. This has been a lot of fun for us here at Brayshaw Financial Group to really just discuss, a couple of sectors for you to look at inside of your portfolio. Whether you're paying attention to supply chain issues or shifting in consumer preferences or the rise of private label brands, whatever's coming across your desk and you're looking at right now, believe it or not, these are a couple of sectors that have a relationship in there. And how that relates to you having a healthy portfolio and really being successful in retirement and successful in your investing. We hope that this has been eye-opening and fun for you at Money on Tap. Cannot wait to be here with you next week. And also, real men wear pink, just in case you were wondering. There you go. We'll see you.
All All season long, it's Money on Tap's Summer Sector Series, each week exploring a different high-growth industry, analyzing major players, market trends, and emerging opportunities. Join us again next week for more smart, sizzling investment opportunities here at Money on Tap. The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of Osaic Wealth Incorporated. Osaic Wealth Incorporated and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire 03110, and can be reached at toll-free 855-226-8551.